get started. Guys, welcome to the first ever, or the first of many, Pease and Associates Tax Talk. I see that we're expecting about 100 folks online. People are still joining in, so we certainly appreciate you taking the time to join us today. A topic that's on everyone's mind has been tax reform. So I don't think there could be a more appropriate topic to start off with our first tax talk than tax reform here. We're really looking at this as an opportunity, this tax talk, this webinar, as an opportunity to continue the discussion with our clients. Our format will be brief, it'll be concise and to the point, and certainly we won't bore you with a lot of details that us accountants are certainly used to. So with that being said, our mantra or objective today is really just start the discussion. You're going to hear throughout the presentation, there are many unanswered questions, and that truly is the case. There's a significant amount of changes that were made to the tax code that were kind of rushed through by the end of the year, obviously for political reasons. In fact, what you're going to hear throughout this presentation that, we're waiting for information. When there's such significant reform on the tax side, the IRS usually issues what's known as a blue book. And this blue book really gives us a better idea as practitioners as well as taxpayers what the true intent of the law changes were. Unfortunately, that will not be released, or we're not expecting that until May or June. Candidly, we're expecting, technical corrections probably into 2019. So this is certainly going to be a very long ride for us. So we're going to tackle this journey together. All right, guys, so let's get started. With today's presenters include Jen Barnes, who's a tax partner in our Cleveland and Akron office. We also have Kathleen Moran, who's a tax manager in our Cleveland office, and we also got Melanie Hicks as the tax manager in our Cleveland office, and I will be moderating the proceedings today. By way of background, President Trump signed into law the Tax Cuts and Jobs Act on December 22nd, 2017. As he's been promising through the election or leading up to the election, it was a sweeping tax reform law that promised to entirely change the tax landscape. The effective date for the majority of these provisions are for tax years beginning after December 31st, 2017. I know we're all concentrating on the new tax law changes, but keep in mind there is what we call a sunset date. That is, a lot of the individual tax provisions that Melanie will be addressing are set to expire after the 2025 tax year. As they were leading up to the final bill, and as Congress was leading up to, or the president to sign the final bill, there was a lot of concepts that were being circulated around the holidays. Some of these concepts that I'm going to mention on this slide did not ultimately make the final bill. A lot of the concepts that our folks are going to be talking about are the ones that are actually in the bill. There was a lot of talk of the elimination of the estate tax after 2023. That did not occur, but there were some changes to estate tax as well. Near and dear to a lot of our hearts was the AMT. Unfortunately, they did not eliminate the AMT for individuals. However, they did increase exceptions, and again, Melanie will be talking about that as well. There was also talk of repealing the deduction for student loan interest. That thankfully did not occur. There was also talk of repealing the Schedule A deduction for medical expenses. And finally, they were also discussing repealing the work opportunity tax credit, which again, thankfully that did not occur. And again, this list that we were showing is not an all-inclusive, but just wanted to mention so you can reconcile some of the things that were being said before the final bill was actually signed. So today's agenda, we're going to be talking essentially three major areas: business tax provisions, which includes corporate tax that Kathleen's going to start talking about in a second, as well as pass-throughs like S corporations and LLCs that Jen will be talking on. And then our resident individual expert, Melanie, will be talking on the individual tax provisions and the estate tax provisions. All right, with that in mind, guys, we're going to get started with business tax provisions. And Kathleen, we'll start talking on the corporation. Kathleen?
Thanks, Joe. Good afternoon, everyone. I'm going to start by going through the C Corp and business tax provisions, starting with some of the provisions that are more taxpayer friendly, and then ending with some of the tax provisions that aren't as taxpayer friendly. So one of the more taxpayer-friendly provisions of the new tax law is the change in the C corporation tax rate. C corporations are now subject to a 21% tax rate, and this is for tax years beginning on or after December 31st, 2017. One of the reasons this change was enacted was to make the United States more competitive with corporate tax rates in other countries. As you can see on the attached schedule, it appears that the rate may have dropped up to 13 or 14%. However, as C corporations, if you are a manufacturer receiving the 9% CPAs deduction or various tax credits, your effective tax rate under the old tax law was lower than the 34 or 35% rate on the attached schedule. However, the reduction is still a strong, significant benefit of the tax reform. As a side note, the 9% CPAs deduction on qualified production activity income has been repealed and replaced with the QBI deduction for pass-through entities, which Jen is going to discuss later on. C corporations are going to consider the impact of the reduced rate on deferred tax assets and deferred tax liabilities. Fiscal year C corporations are going to have to use blended tax rates for purposes of calculating their tax provisions. Regarding the dividends received deduction, as you can see on this slide, the 80% dividends received deduction is reduced to 65%, and the 70% dividends received deduction is reduced to 50%. This keeps the tax collected on dividends the same as pre-tax law changes. C corporation AMT has been repealed. This is another C corporation friendly provision. Prior year minimum tax credits generated when corporations were in AMT and paid AMT in previous years is refundable up to 50% of the credit through 2020 and refundable up to 100% starting in 2021. There's been some significant changes regarding net operating losses. In 2018, NOLs generated in 2017 and prior years can offset 100% of taxable income. Starting in 2019, NOLs generated in 2017 and prior years can still offset 100% of taxable income. However, NOLs incurred in 2018 and later years can only offset 80% of taxable income. The new law allows unused NOLs to be carried forward indefinitely. Also, there is no carryback of NOLs allowed under the new tax law. Under the prior tax law, NOLs could be carried back 2 years and forward 20 years. Next, I'm going to talk through some depreciation changes, and I'm going to start with bonus depreciation. These provisions apply to all taxpayers, C corporations, pass-through entities, and sole proprietors. And as Joe mentioned, most of these changes are starting effective 1/1/18. However, some of these bonus depreciation changes come into play for the fourth quarter of 2017. The new bonus depreciation provisions allow taxpayers to expense eligible property or 100% of eligible property under the new law as opposed to 50% under the prior law. This change applies to assets acquired pursuant to a written binding contract entered into after September 27, 2017 through December 31st, 2022. So, for example, if on September 12, 2017, a taxpayer and a vendor signed a binding purchase order on a piece of equipment, and that equipment is delivered to the taxpayer and placed in service on October 10th, that equipment does not qualify for 100% bonus depreciation because the binding contract was signed prior to September 28, 2017. This property would continue to qualify for 50% bonus depreciation. You can see the scheduled phase-out amounts on the attached slide for years following 2023 on the attached schedule. Bonus depreciation is scheduled to be phased out from 2023 through 2026. Another new bonus depreciation provision is that property no longer needs to be original use property, but it must be the taxpayer's first use. So taxpayers cannot purchase property from related parties or related entities to qualify for bonus depreciation. This is an exception to this rule. This rule is taxpayer friendly for buyers in the case of asset acquisitions. It's also important to point out, as the law currently reads, bonus depreciation is not available for qualified improvement property. As a result of this omission, qualified improvement property would have a 39-year recovery period and not be eligible for bonus depreciation. It does not appear that there's a binding contract rule for qualified improvement property, and the focus is more on the placed in service date. Bonus depreciation was available for qualified improvement property under the old law. It is hopeful that there will be a technical correction in the law to allow for this. There are articles online that address and discuss this. Real estate industry representatives are in active conversations with Treasury and the Joint Committee of Taxation regarding this matter and are working toward a solution. We are going to have to wait for more guidance in this area. Taxpayers can elect out a bonus depreciation, but must do so for all assets within a class. So for example, 5-year assets and 7-year assets are classes of assets. Also, bonus depreciation is not eligible for businesses that have floor plan financing indebtedness. So taxpayers are going to need to coordinate bonus depreciation opportunities with the QBI deduction, which Jen is going to discuss next. Bonus depreciation can create net operating losses. Section 179 expense, which I will discuss later on, cannot create net operating losses. Depreciation limits for luxury automobiles have been increased. The new law increases the maximum amount of depreciation deduction to $10,000 for the first year, $16,000 for the second year. So you can see the changes on the slide have been significant. Under the new rules, luxury auto now means a cost greater than $50,000. Regarding Section 179 expense, effective for property placed in service after December 31st, 2017, the annual limit has been raised to $1 million. And this was previously $500,000 under the old tax law. All limits have been increased for inflation annually, as you can see on the attached schedule. Other important change regarding Section 179 expense is that the definition of eligible property has been expanded to include roofs, HVAC property, fire protection alarm systems, and security systems. Now I'm going to talk about accounting method changes, which are also very taxpayer friendly under the new tax law. Taxpayers can now elect to use the cash method of accounting as long as average annual gross receipts for the prior 3 years do not exceed $25 million. The previous threshold for this was $5 million. As we're preparing your 2017 tax returns, we will examine whether or not you will qualify for this change, and we can discuss this at that time. Taxpayers are also allowed under the new tax law to account for inventories using the same method as reflected on their financial statements. And this is as long as their average annual gross receipts do not exceed $25 million. The new tax law raised the threshold to $25 million before Section 263A uniform capitalization or UNICAP is required. This provision has been in place since the 1986 Act for producers, manufacturers, and resellers distributors. For any of these changes, taxpayers would need to file a Form 3115 for the IRS, an application for accounting method change. Now I'm going to move on to some of the taxpayer unfriendly provisions, starting with deductibility of interest expense. The new tax law disallows interest expense in excess of 30% of a business's adjusted taxable income. The new tax law states that adjusted taxable income is computed without regard to the deduction for depreciation, amortization, or depletion through 2021. This definition is similar to EBITDA, so to determine the adjusted taxable income, you would start with taxable income, add back depreciation, amortization, and depletion. This amount gets multiplied by 30%, and any interest expense in excess of this amount would be non-deductible. This non-deductible portion will either be an unfavorable M1 for flow-through entities or a deferred tax asset for C corporations. This amount is determined at the tax filer level, and any interest expense disallowed would be carried forward indefinitely. Starting in 2022, the adjusted taxable income calculation is similar to EBIT. Depreciation and amortization will not be included for purposes of calculation. So once these non-cash add backs are removed from the calculation, this would have a more significant negative impact on heavily financed businesses. One takeaway from this is to consider when structuring investment opportunities to consider using preferred equity instead of loans. Interest expense deductibility limit doesn't apply to floor plan financing for auto dealers, real estate trades or businesses that elect to use ADS instead of bonus depreciation, and businesses with average gross receipts for the prior 3 years of less than $25 million. However, you'll have to keep in mind that this $25 million threshold is tested on the affiliate basis. Now I'm going to move on to more taxpayer unfriendly provisions, and those are regarding meals and entertainment. So under the new tax law, entertainment expense is 100% non-deductible. Any activity considered entertainment, amusement, recreation is no longer deductible for tax purposes. And under the prior tax law, these entertainment expenses were 50% deductible. Client meals are likely subject to the 50% limit. Any meals for the convenience of the employer, however, which were previously 100% deductible under the old tax law, are now 50% deductible, and then starting in 2025, these will become 100% non-deductible. The presumption is that meals related to entertainment activities will likely be subject to the 100% disallowance. So for example, if you take a client to a baseball game, have dinner before the game, have a legitimate business discussion, that meal, because it's associated with entertainment, would not be deductible. However, if you take your client to dinner and don't follow that with entertainment activities, the presumption is that that meal would likely be 50% deductible. We're still waiting for more guidance and interpretation in this area. Social and recreational expenses for the benefit of employees, such as holiday parties or a company picnic, would continue to be fully deductible. This is one of the few items that didn't change under the new tax law. An important takeaway on this is to consider updating your chart of accounts to carve out entertainment expenses, meals expenses, and any meals expenses associated with entertainment. There's a slide that recaps next, which goes through the prior deductibility under the old tax law of these various categories and the new provisions as they stand. It's a good comparison chart for reference. Also changing is employee achievement awards, which under the new tax law, there's no deduction for cash, gift cards, or various other achievement awards unless these are included in employees' W-2s. Lastly, just wanted to mention there has been some changes regarding R&D or research and development expenses. However, these changes are for tax years beginning on or after December 31st, 2021. R&D expenses are going to be required to be amortized over a 5-year period starting at this time. Under prior tax law, these costs could be expensed. However, there is some speculation as to whether or not this provision really will be enacted starting in 2023 or modified, so we will have to wait for more guidance on this.
Well, thank you, Kathleen. There was certainly, excuse me, quite a bit of changes. Some of them taxpayer friendly and some not so much taxpayer friendly, but thank you so much for summarizing those. As we pivot over now, Jen's going to continue the discussion on the business tax provision side with pass-through entity changes. I'm sure there's going to be significant changes in this arena as well. Jen?
Thanks, Joe. Thanks, everyone, for taking the time to come listen to us. So today I'm going to talk about the biggest change for pass-through entities, which is called the Qualified Business Income Deduction, or QBI. It's Code Section 199A, which did replace the old Code Section 199, which was only available for manufacturers. So this is opening it up to a broader group of taxpayers, and it's trying to get the individual rates, which you'll find out from Melanie's, have come down a little, but not as much as the corporate rates have come down. So they're trying to keep the businesses on an equal playing field. So the calculation for QBI is 20% of income deductions, gains and losses of your business income. It does not include any non-business income, such as interest or dividends you might receive from a portfolio. Additionally, it does not include any salaries or guaranteed payments that the owners would have received from that pass-through entity. The deduction is phased out for all service businesses. So unfortunately, the accountants, the lawyers, and the doctors did not get as much of a benefit. They do get the deduction as long as their taxable income is below $315,000 for a married couple, or $157,500 for all other taxpayers. And it's also a different phase out if you're married filing joint, which is $100,000 or $50,000. So as you can see, this could benefit a lot of people to make sure that you're calculating your income correctly. However, nothing's as simple as to say it's just a straight 20% deduction. There are thresholds that have to be met in order for you to be able to claim the credit. So we call it, I call it a two-pronged test. The first one is that you need to have, you get 20%, but it's limited to 50% of your W-2 compensation paid during the year. So it's on a cash basis, not an accrual basis. And it does not include the owner's salary. If you don't meet that criteria, then you could look at the second criteria, which is the 20% is limited to 25% of the W-2 wages, or 2.5% of the unadjusted tax basis of your depreciable assets. So if you're a real estate entity that doesn't have wages, they wanted to make sure you could still get the deduction. So that's why they included the asset test. So when you're looking at this, it is a deduction for both AMT and regular tax purposes. This deduction will be fully eliminated after 2025. The QBI is a below-the-line deduction, which means it doesn't calculate your AGI. It comes in above your itemized deductions, which is important when you start looking at your state taxes, because a lot of the state tax returns start with adjusted gross income. So it's important to note that this deduction is probably only available at the federal level. As I haven't seen much yet, the states really haven't come out with guidance on whether they're going to give you this deduction at the state level. So if you're a multi-state company, you're probably going to want to keep an eye on what the states are saying they're going to allow as a deduction. I know 199, when it was in place, some states and cities allowed it and others didn't. So it's one of those things on whether or not they're going to decouple from the federal tax law or not. So we also wanted to, so after you get past those first two tests, there's a third test. Your deduction is limited to 20% of your taxable income. So as you can see, like I said, it's not a straight 20% deduction. So we wanted to give you an example of a quick calculation. So Bob Smith, as you can see, has wages from, let's just say, Corporation 1 of $200,000. Bob owns 3 S Corps. One makes $700,000, one makes $300,000, and one lost $400,000. He has other income, interest, dividends of $75,000. So if you were looking at it, under current tax law, his adjusted gross income would be $875,000. I'm assuming in this scenario that none of the 3 corporations have an issue with the W-2 limitation or the asset limitation. So they would qualify for the full 20%. So under that, they would have a QBI deduction of $200,000. However, when we do the 20% limitation, it's only $175,000, but they would be limited to the $175,000, and their taxable income for these 3 entities would be $700,000. It's a note that if you don't qualify for the 199A deduction because of a net loss, that loss will carry forward for next year to calculate your 199A deduction as well. So you really want to plan appropriately when you have multiple entities to make sure that you're able to maximize your ability to claim the QBI. So one thing you could look at is, in this scenario, to try to get up to the $200,000 deduction, you could have elected out of depreciation like Kathleen talked about. So there's different scenarios and planning techniques you could do, or maybe take less wages, because remember, wages don't qualify for the QBI, but the S Corp income would. So if you take your wages down a little bit and then increase your S Corp income, you could have gotten more of a QBI here or there, especially if you were Corporation 3. So it's always important to make sure that you're planning appropriately. You don't want to wait to the end of the year. A lot of these changes you can't make in December or November. So it's going to be more important that you plan in June and July, and make sure it's hard to take away wages. So if you want to if you want to plan appropriately, then you need to start planning early. So I would say, make sure that you're contacting your accountants earlier this year and everything else. So if we go to the next slide, we wanted to kind of give you an idea of how they came up with this 20% number. How did they come up with the 20% deduction? So if you had an S corporation that didn't take any, or C corporation that didn't take any, there's a double tax. There's a 21% tax at the corporate level, and there is the 20% tax or 23.8% tax at the individual level. So if you were to look at the this slide is comparing like a C corp versus an S corp. If you look at the far right-hand side, you can see if they take out 0 distributions, their net tax would be 21, and an S corp would effectively be 29.6. So in that case, you'd probably want to switch to a C corporation and maybe save some tax money, because most of the time, flow-through entities only take distributions for taxes, and if you make the tax at the corporate level, then there would be no distributions. However, not everyone wants to live like that, so they like to take distributions from their company and don't want the cash to build up. So we kind of did some different scenarios here on if you distribute your earnings after taxes, what would be the net tax effect of both the entity level tax and the individual tax. And as you can see, as you take more money out of the company, the double tax kind of increases the effective rate of the whole transaction. We've determined that the break-even point is 42%. So if you're distributing 42% of your profits, then the C Corp, S Corp are equal. Now, one of the things we've considered in planning for some of our clients would be, they're sitting on a big AAA account, which a AAA account is the amount of money that's already been taxed that you haven't taken as distribution. So we said, what if we take that and do a distribution as of, let's say, 12/31/17. Instead of giving the cash, though, because remember that distribution is tax-free, we give them a note. And you leave the note on the books. And then the next page. Then you can flip the corporation to a C Corp for 5 years, because it's important to know that your election, once you either elect S or elect C, this election you can't re-elect until 5 years have passed. So then you could say, we're going to take our distributions from our note, which is tax-free, minus the interest would still be taxed. And you want to make sure your note has interest to make it valid and a valid document note. And then you make the corporation a C Corp, which pays the lower tax. And you could save, so if you were to, the next page, and then you'd save the state tax deduction as well, because when you're flow through, the taxes are paid at the individual level for multi-state, which we all know is now limited to $10,000, but a C Corp can deduct all their state and local taxes. The election to make an S Corp or C Corporation change is March 15th. Now, I don't want you to be in a rush to make this decision, because as Joe mentioned, there's still a lot of definitions, especially in the QBI section, that need to come out with the blue book, so we can figure out what is going on and so you can make a prospective election. So let's say, after the blue book comes out in June, you decide I want to be an S Corp, then you could just cut your S Corp return in June and start being a C Corp in July. So don't feel in a rush to jump and make the change. So here is an example of the C Corp versus S Corp planning, the one that I mentioned to you. So we have an entity that has a AAA balance of $15 million. They declare the distribution of $15 million with a note. As I mentioned before, you want to make sure you have a valid legal document for the note with a stated interest rate so that it will be acknowledged and accepted by the Internal Revenue Code, Internal Revenue Service. They have annual income of $10 million. We decide to revoke their S election on 1/1/2018. As they take the distributions over the next 5 years, as I mentioned, there's no tax on the 15 million distributions they receive in the note. The company gets to deduct the note interest as long as they don't exceed Kathleen's previously discussed limitation. And you could save $960,000 a year. So if you think about that, that's a lot of money to consider. And like I said, you still get your distributions, the company saves money, and then in 5 years you can reevaluate to see if you still want the distributions. It's important to note that you want to make sure that your compensation is reasonable. You don't want to take your compensation too low to try to, or too high to try to get more cash out. You want to be comparable. But as you can see, this QBI section is very complex. So to try to put it in a nice flow chart that we got from, we got this from the AI CPA, but as you can see, there's a lot of yes, no's, and to determine what exactly your deduction is. And one of the things that needs clarified is, they say that the deduction is 20% of your trade or business income, but they haven't really defined trade or business income. So is it, if you own 5 companies that are all the same type of entity, like you have 5 employment companies, would that be 1 trade or business, or would that be 5 trades or businesses? Right now, we're interpreting it, and from other people we've talked to, they're interpreting it as if you test at every individual company level. But we're expecting more guidance in that area, just because they used a generic term of trade or business. So we'll get more on that in the future. So one more not so taxpayer-friendly area is the loss limitation rules. In the past, as long as you had basis, you could claim all the losses from your company, whether it be a partnership, sole proprietor, or an S corporation. So if you owned 3 entities and they netted to a loss of $2 million and you had the basis, you could claim the full $2 million to offset your other income or create an NOL. The new rules say that business losses are limited to $500,000 for married filing jointly, or $250,000 for all other taxpayers. If you exceed the threshold of $500,000, the excess amount will carry forward to next year as a net operating loss, subject to the new limitations, which Melanie will go over here in a little bit. So as you can see, there's a lot of planning to do here. If you have a bad year, you want to make sure that you're, trying to minimize the amount of losses you have, or maybe you're expecting to turn around next year and you're okay with the NOL going forward, but it really requires a lot of conversations and a lot of thinking ahead. You just want to make sure you're on top of this and that you're looking at it and making sure you go through the calculation. Like I said, you almost need to go through the calculation. Is it better to be an S Corp or C Corp? If I'm going to stay an S Corp, what will be my net effect on my return? It's not as straightforward as it used to be. So now we wanted to go over some changes that are specific just to partnerships. In the new tax law, they repealed the technical termination provisions. Under the old rules, if you had a greater than 50% change in ownership in a 12-month period, and it didn't even need to be 1 transaction, it could have been 2 transactions, just as long as it was within the same 12-month period, you'd have what's known as a technical termination. That means that you basically file a final return, and as the new partners come in, you file a new initial return, and you get to do all your elections over again. And obviously, that was very taxpayer-friendly. So the government said that we're going to treat partnerships more like S corporations. It doesn't matter how much ownership change you have, the partnership's going to continue to exist, and you don't get to re-elect anything without doing a Form 3115 like Kathleen talked about. The next change is more a change in the audit process. So under the old audit provisions known as TEFRA, you would have the audit adjustments go through all the way down to the individuals to figure out what the change in tax was. And that became very difficult for the IRS with tiered partnerships, and just trying to get all the information together, get everyone to sign off. So in order to make this quicker and easier for the IRS, they said now they're going to calculate the tax and the penalty and interest at the entity level and have the partnership pay it. So under these new rules, you can also elect out back into the old TEFRA. The problem with that is you can only elect out if your owners are individuals. If you have a trust or an entity in your structure, then you are not permitted to elect out. Another part about this new audit procedure is that you need to identify your partnership representative, and you need to adjust your operating agreement. So everyone who is a partnership should be amending their operating agreement to identify this individual. This individual will be the person that will work with the IRS during audit. It does not have to be a member or a partner of the partnership, but so make sure you're talking to your attorneys and getting all of your paperwork updated appropriately.
So much so for tax simplification. I would call that fake news.
Well, exactly. It's very cumbersome. And
I'm glad, one of the questions that we're getting here, and I'm sure all other accountants are as well, is do I convert from an S Corp to a C Corp? And I'm glad you covered that area, Jen, where it's not a simple answer as it was before, and it really is going to take quite a bit of analysis to determine what the best route is for individual clients.
Absolutely, and it's a case-by-case scenario. Everyone's going to be different. I guess one more point to add is because this election to change structure is 5 years, if you have any intentions of selling in those 5 years, you really have to look at it because an asset sale versus a stock sale will be very different for an S Corp versus a C Corp. So, like we said, it's not really looking at 1 year, it's looking at that 5-year period.
Really good point. Thank you, Jen. Before we move on to our resident individual expert, there are a couple of questions that we have. The slides will be available in a follow-up email after this presentation, as well as a playback. We'll also have this on our website. And there was another question if we had covered the meals, travel, entertainment changes. We did cover that in an earlier section. I think those are the only two questions I see at this point. With that in mind, I'm going to turn it over to Melanie. She will cover not only the individual tax provision changes, but also the changes of to the estate tax as well. Melanie?
Thanks, Joe. Good afternoon, everyone. So I'm going to spend the next 10, 15 minutes or so going over the changes to the individual and estate tax provisions. So we get to change gears a little bit and stop thinking about businesses and thinking about ultimately how much money will we pay at the individual level. Some of the individual highlights that I will cover will be the revised tax bracket structure, the personal exemptions, they've been eliminated and how that is being handled. Standard deduction has been increased across the board. There are various itemized deduction changes. The child tax credit has been expanded. Just a quick update on kitty tax. They tried to simplify it as best as they could. There have been enhancements to the Section 529 plan. And then, of course, the alternative minimum tax exemption and phase-out thresholds have been increased. In 2017, for individuals, the highest tax bracket for married filing joint was 39.6% for taxable income in excess of $470,000. Now, in 2018, that bracket has been, the highest tax bracket has decreased for married filing joint to 37% for taxable income exceeding $600,000. As you can see from the charts, they've also increased the threshold. So what it's going to do is you're going to enter the higher brackets at a slower pace than you did previously. Personal exemptions, as I mentioned in the beginning, have been completely repealed. So in order to offset the impact of the repeal of the personal exemption, the standard deduction has been increased across the board, and the child tax credit has been increased along with the addition of a new family tax credit. For married filing joint, in 2018, the new standard deduction is $24,000 as opposed to $13,000 in 2017. As you can tell from the chart, they've almost doubled in all the different filing statuses. And again, this is to make up for the fact that the personal exemption has gone away. I know a lot of information has been surrounding the changes to the itemized deductions, specifically Schedule A. So before, I'm hoping we were all, you guys heard me before I was starting to talk about the changes to the mortgage interest and the new limitation on the interest deductibility. So interest is going to be limited to up to $750,000 of acquisition indebtedness on your mortgages, and that's going to include primary and secondary homes for any mortgage incurred on or after December 15th, 2017. There's been a lot of talk, and I know a lot of noise has been out there that the home equity line of interest is no longer deductible. That is not necessarily true if, again, it is for this new indebtedness incurred after December 15, 2017. The difference is now the proceeds will have to be used for substantial improvements to the home. So you can no longer take out a home equity line of credit to finance things other than improving your home in order for it to be deductible. And along with that, that loan, in addition to your mortgage, cannot exceed the $750,000 of total indebtedness. The $1 million limit also applies to binding contracts incurred before December 15, 2017, providing the residence is purchased before April 1st, 2018. So I say that before this changed, the interest limitation was on $1 million of mortgage indebtedness as well as $100,000 on home equity line. The $1 million still exists. It actually got grandfathered in, but the $100,000 for home equity or just home equity loan interest in general wraps into that new $750,000 limit. Tracing of home equity debt proceeds for Schedule A, E, F, or investment is still allowed. Another change has been to charitable contributions. Before, charitable contributions were based on 50% of adjusted gross income for cash donations to most charities. Now that limit has been increased to 60% of adjusted gross income, and the 5-year carryover rules are retained. One of the major changes to this is the 80% deduction for college seating rights has now been eliminated. Personal casualty losses have been repealed except for declared disasters, and miscellaneous itemized deductions subject to 2% of adjusted gross income has been repealed. That's going to include items such as investment advisory fees, unreimbursed employee business expenses, tax preparation fees, and keep in mind, you still need to pay your tax preparation fees, although they no longer will be subject to seeing if you can deduct a portion of them. Other things under miscellaneous itemized deductions would be union dues, safe deposit boxes, various items like that. As I mentioned, earlier about the child tax credit, as you can see from this slide now on the screen, the child tax credit has been increased from $1,000 to $2,000. That new family tax credit is $500. What is significant in this enhancement is the phase out. In 2017 and early years, it was very easy to phase out of getting that deduction. And now the phase out in 2018 going forward, it begins at $400,000. Now it still is for children under age 17 and under. There's also been an increase in the refundable portion of this credit. It has increased to $1,400 up from $1,000. I mentioned earlier about kiddie tax simplification. So basically what they've effectively done is they're going to look at the kiddie tax and will apply the ordinary and capital gains rate applicable to trust and estates to the net earned income of a child. That maximum tax rate is 37% on income of $12,500 and higher. In order to even be subject to this tax, your child has to at least have an income of $1,500.
So I'm glad you brought that up, Melanie, because this is actually going to change the planning historically with regards to kiddie tax. Before, folks were trying to shift more and more monies to their kids to take advantage of the lower rates, but it's just the opposite going forward.
Absolutely. So in the area of adjustments to income for alimony, for divorce agreements executed after December 31st, 2018, alimony payments are no longer deductible, which also means that the recipient will no longer have to pick up that income as taxable income. This is after December 31st. I know this is going to sound kind of weird, but if you're in the process of the divorce, you might want to accelerate and get it done this year to make sure you can still deduct it. Again, it's for agreements executed after December 31st, 2018. Another adjustment to income that has been repealed are the moving expenses. They are no longer deductible except for if you're in the military. We have some education provisions. I know a lot of people in the past, they always call and ask, you know, can we use our Section 529 plans for other than college. Well, I think your request has been answered. The Act modifies Section 529 to allow such plans to distribute not more than $10,000 in expenses for tuition of the designated beneficiary at a public, private, or religious elementary or secondary school. This limitation is applied on a per student basis rather than a per account basis. Also in the area of student loan, for the discharge of student loan indebtedness, starting in 2018, forgiveness of student loan debt will not be taxable income to the student as a result of that student's death or total disability. Now we all hate the dreaded alternative minimum tax. Well, discussions were tossed around about eliminating it, which is not going to happen, but they've tried their best to make sure that a lot of people now will not be subject to it. They did accomplish that by raising the exemptions and also increasing the threshold, the phase-out thresholds. For married, filing joint, and surviving spouse, the exemption has been increased from 109.4 up from 86.2, and the threshold is now $1 million, which is a huge jump because it's up from 164.100. As you can see, also the exemptions and thresholds also increased for all other categories of taxpayers.
You know, Melanie, the original, and a lot of folks don't know this, but the original purpose of alternative minimum tax was to hit the wealthy, the ultra wealthy. When A&T first came into existence, it was really targeting less than 500 families back in the 60s. And clearly over the years, it extended to much more families and much more taxpayers than it was truly originally intended for. So this change is more in line with the true intention of the alternative minimum taxes.
Absolutely. Now, Jen had touched earlier on the loss limitation rules, and so I'm just going to just add further to that. So now, as opposed to the loss limitation rules being looked at and decided at the business level, they're applied on the taxpayer level. So active business loss, as Jen mentioned, is limited to $500,000 for married, filing joint, and $250,000 for all other taxpayers. The amount that cannot be used can be converted to net operating loss and carried forward indefinitely. Prior to 2018, 3 tiers were applied in determining deductible business losses, and now they've added a 4th one, which is the active loss limitation. So as well as adding that 4th tier, they've also then capped the limitation at the $500,000. So an example would be if you had wages before 2018, if you had wages of $2 million and you had active business losses of $2 million, your adjusted gross income would net to 0. Now, if you still have wages of $2 million, your loss will be limited to $500,000 and your adjusted gross income will be $1.5 million going forward. Just a quick update to the net operating losses. It is now limited to 80% of taxable income. Before the limit, it could be carried forward to 20 years. Now that carry forward timeline is indefinite, and no carrybacks are allowed after 2017, except for in the cases of casualty or disaster losses. On the next table just basically shows, Joe had mentioned when he first opened the presentation that a lot of the individual provisions are set to sunset. And so that's just going to say they're here on a temporary basis from 2018 to 2025. The items that will not sunset is the elimination of the healthcare individual penalty, the longer holding requirement for carried interest gains, and the higher charitable given deduction limit. Those will remain. Just some quick planning tips. Like I said before, by increasing the taxable income thresholds, the new 7-bracket system provides for a slower increase in reaching the highest tax bracket. You will want to consider, if your real estate taxes are $10,000 or less, you would want to consider prepaying those every other year to itemize to try to get the benefit of itemizing or using the standard deduction in years where it's beneficial. The same thing would go for the coordination of timing of charitable deductions. The marriage penalty has basically been eliminated by all of the increases in the thresholds. Also, due to the limitation of SAW deduction, U.S. Treasury U.S. Treasuries may be a more attractive investment alternative than the state muni bonds for residents of states imposing an income tax. That is all we have for the individual portion. Just real quick for the major changes on the estate provisions. Again, every presidential change election, they're always trying to completely eliminate the estate tax. Again, that failed to pass, but effectively what they've done is they've made it harder now for a lot of families to have to pay estate tax by increasing the unified basic exclusion amount and the exemption. They have basically doubled from $5.6 million to $11.2 million for individual taxpayers, and that would be $22 per couple. The portability rules remain unchanged. These rules allow the unused exclusion from the first spouse's death to be transferred to the surviving spouse. Another thing is the step-up in basis is retained at death. And again, the higher exclusion and exemption amounts will sunset on December 31st, 2025. So in essence, for the step-up in basis, it's not like you won't be planning for estate taxes. You're more or less now going to be planning for getting the best utilization of the step-up in basis on assets being transferred. And the last slide just talks about the generation skipping transfer tax. And again, that exemption has been increased from $5.6 million to $11.2 million per individual. And again, it doubles for couples. I appreciate your time. Thank you so much.
Well, I'm trying to determine, I'm keeping a scorecard here, what's got the most changes? Is it the C Corps, is it the pass-through, or is it on the individual side? It is clear that, you know, at the outset of this discussion, we mentioned that there's a lot of unanswered questions, as you could clearly see, certainly are. It's going to be a roller coaster ride, and we look forward to going through this ride with you. And looking at the chat box, I don't see any further questions. We will, as your advisors, will certainly reach out to you to continue this discussion. But if you do have some questions that come up in the meantime, feel free to reach out to us as we are here to answer your questions. Again, this was the first of a series of tax talks. Stay tuned for the next one. You know, we're looking to do this more frequently so we can continue discussions with our clients. With that in mind, I mentioned earlier the slides as well as a playback will be available in a follow-up email, as well as across all of our various social media platforms. With that, guys, thank you for joining us today. And we'll have the discussions again in the future.